How are you liking your China exposure right now?
Well, we like the stock market right now. If you noticed, when we see the big sell-offs in global markets, we're noticing there's less and less happening on the China side. We know the stimulus is there from a financial market perspective, but it's still stuck in the financial markets. So we can see the overnight repo rates are really low there, closer to 1%, when they probably should be closer to 2%. So it's telling you there's lots of money sloshing around the financial markets. Plus, I always keep in the back of my head that this is the single largest deposit base China's ever had. So if that gets deployed into the local stock market, we could be in for a boom time. But our expectation is it's going to rally slowly over the next 2 or 3 years. It's going to be one of those grind rallies right now.
I just have to ask you, Hayden, about Korea. In November last year, I was in Seoul when the Korea's Legoland credit crisis began, and it had quite a ripple effect for a while in that part of Asia. But I'm wondering now, there's another situation in Korea, rising default rates at credit cooperatives. This has sparked deposit outflows from lenders and even some interventions from regulators. Are you following this? Is there something brewing here again?
Yeah, look, obviously, I think they have some pretty tight restrictions, and they've been flowed through a few of these episodes in the past. When a lot of people look at those banks, the way the housing market works and the amount of deposit you have to put up front if you're a renter is very different to what you find in other parts of the world. So they look highly levered because they have to borrow more money from the banks, essentially. So on paper, it looks very, very levered. I think the banking sector will be able to get through this. At the end of the day, they're very, very conservative banks in an overall perspective. But the market right now is latching onto it. And they're putting pressure on the bonds there and obviously putting pressure on the equities. So it's something to watch out for the second half of this year. But, my general starting point is the Korean banks are generally pretty conservative.
Yeah, and they're very closely regulated. That's one thing for sure about Korea. So you say in your notes that you want to maintain healthy allocations to fixed income relative to value strategies because you think they'll continue to benefit from the current environment in Asia broadly. Explain to us exactly what you're looking for.
Well, I suppose when you think about value, in a price sense, Asia's really cheap, and particularly the China piece. And China is cheap relative to the rest of Asia. A lot of those key countries like Japan, Taiwan, and South Korea, they've benefited with this AI trend that we've had in the first quarter. So China still looks extremely cheap to us. And we also want to own some bonds now. Obviously, yields back. If you make a mistake and the yields are going higher here, well, you've still got quite a buffer. So it's hard to get a negative total return now. So portfolio construction, it's been a really bad idea last year to own bonds and equities. This year, you probably want to own bonds and equities again. And as I said, the value trap here is not, I think that's not the case. We've got supply coming through, we've got stimulus coming through, and we've got particularly on the China side, we've got a government willingness, which has done a 180-degree turn, and they're looking to support the market. And they've come out some pretty positive comments around supporting the stock markets. Has been very specific there. So I think stay tuned for that. But it's a 2 to 3 year rally. This is not a V-shaped recovery. It's a grind market.